The Fed's going to raise by 25 basis points.
Krishna.
They're going to hike 25, and I think signal that they expect to be hiking again in December.
In December. What they do is one thing. What they say or eliminate from saying from previous statements is quite another thing. I was reading your report, Krishna, and you think that they will remove the language. Well, let you describe what language they may remove and what it means.
So right now, the Fed has a line in the statement that says policy remains accommodative. In regular English, that means it's stimulative. It's below the neutral rate setting, if you like. I think that at this meeting, that language goes. So they no longer describe policy as accommodative. Now, the question is, what does this mean? Is this dovish? Is this hawkish? My sense is that the market may be tempted to read this dovish.
Why? Because if they're not going to be accommodative, the opposite of that is restrictive.
So what you say, I think, has a certain basic common sense to it. But I think there is a mindset in the market that Jay Powell has told us he's just taking rates back to neutral. And so when they get rid of this language, what they're saying is they're starting to draw closer
they're getting close
to that neutral setting. Now, my own view is actually that's not the right way to read it. I think we have to be careful here. In my mind, the Fed is backing away from the idea it has any clue what neutral is. And so that's why they want out of the business of benchmarking rates next to this neutral setting.
There was a piece in the Wall Street Journal today on this very point. It's the R is what it is. Kevin Warsh wrote it. That we're trying to move to a neutral rate. But nobody really does know what neutral means, do they?
Well,
or do you? Maybe Farr knows.
Farr knows, but I'm not going to tell Tyler. I really shouldn't do that. But when you you start with an inflation target. So they have defined a certain goal towards which they're heading, and we know that they have these two mandates, of course, for price stability, and then they have employment. Arguably, they're there on both of those. And what they're worried about is this growing economy that continues to show strong numbers, and they don't want to fall behind that curve. They don't want to be in that 1970s position where we have that runaway inflation. So they play this balancing act with rising rates just in time to try and stay ahead. Maybe they're going to do it, but the saying on Wall Street is that old bull markets don't die. They're killed by monetary policy, and the real risk, I think, is that monetary policy kills this bull market.
Melissa Lee has a question from the floor of the NYSE. Melissa.
Krishna, if the real risk is monetary policy, are you afraid that they're going to raise too many times, or what the market might perceive as too many times in 2019? And we've got new dots coming in on the dot plot. And I don't want to get too wonky, but that could effectively alter where the Fed sees the economy growing and therefore change the way they think about future rate hikes.
Look, I think what the Fed's trying to do is it's trying to balance a set of mostly international and trade-related downside risks with the strength of domestic momentum that creates some kind of medium-term overheating risk. Not inflation running away with us today, tomorrow, next week, next month, but on a 2-3 year view, getting too much inflation in the system. So they're trying to find the rate path that threads the needle here, that gets the balance right between these risks. I'm perfectly comfortable with a baseline of 3 hikes for next year.